It is my pleasure to introduce the first speaker of our program, Laura Starks, Professor of Finance, McCombs School of Business, University of Texas, where she is co-executive director of the Social Innovation Initiative. Laura will be setting the scene on ESG investing. She's done extensive research and she will be presenting us evidence, and this evidence will be on opportunities and challenges. Over to you, Laura.
Thank you so much, Anna. I'm very glad to be here, and good afternoon or good morning to you all. It's just the sun has just been coming up here. I'm pleased to be able to speak to this conference, and what an interesting day it's going to be. I look forward to it. I would like to talk about ESG investing and provide some evidence on the opportunities and the challenges of ESG for investment purposes. The title of today's program is, as Anna just said, the new paradigms in asset management. And if you think about it, if you think about ESG as a big umbrella, then most of today's topics actually are ESG topics. So, for example, climate risk, inequality. These are clearly E, S, and G topics. Each of them, they have those aspects. But if you think about DeFi, it also can be viewed from an ESG lens because it also has environmental effects, it has social effects, and it has governance effects. One central question about ESG is whether ESG attributes primarily reflect a firm's value or values. And this has caused a lot of confusion about ESG because it does have different meanings to different people. And correspondingly, the question is, are ESG investors primarily interested in ESG considerations because of a belief that it has effects on the portfolio's financial value, or because ESG investing corresponds to their own values? One thing I'd like to point out is that ESG investing is not simply SRI investing. SRI investing, socially responsible or sustainable and responsible investing, has been around for many, many years and is really centered on negative screening and people's taste and preferences. On the other hand, environmental, social, and governance investing can be based on taste and preferences. It also usually includes considering return and risk, and it has a number of different approaches, which could be, a positive tilt, a negative screening, looking for return opportunities, looking for risk mitigation. And so for some, ESG investing is simply return and risk without the taste and preferences. For many, it's combining the two. So if we think about the motivations for ESG investing and its implementation, as I said, there's the non-pecuniary aspect of it with taste and preferences. There are also financial reasons, as I talked about, that people might want to pursue ESG. And then given those, we need to consider the differences between the ESG products and the ESG integration into the investment process. So if you think about the taste and preferences, that has more to do with the ESG products. If you think about the financial reasons, that often has more to do with integrating ESG into the investment process. So a number of recent asset pricing theories have given us more insights into ESG investing. And these theories really are based on taste and preferences for the most part. They all introduce non-pecuniary utility into investment decisions. And they focus on weightings of the percentage of ESG investors versus other investors, or green investors versus brown investors. But one of the aspects of this non-pecuniary utility that I've explored with my co-authors, Jackie Humphrey, Shimon Kogan, and Jacob Sagi, are that we did an experiment. And through our experiment, we showed that these non-pecuniary values can actually affect investors' allocation decisions and, to a lesser extent, their probability beliefs. So taking that into account becomes important, I believe, in terms of thinking about ESG investing. Now, you've probably all seen this graph from the PRI that shows how their signatories have been growing, which is the orange line, and that their the blue bars are the amount of assets under management in sustainable investing. So it's been growing quite a bit over time. I think a different way of viewing this is looking at, and this is using U.S. institutional investor holdings data, and then looking at the ESG profile of the companies they are holding. And we find the red line is the high ESG, the blue line is the low ESG, and you can see where the high ESG has been going up over time and the low ESG holdings have been going down over time. So there has been preferences shown for individual stocks in terms of their high and low ESG profiles. There's also a very interesting recent survey by FTSE Russell where they have asked asset owners about their intentions to implement ESG sustainability considerations in their investment strategy. And if you look, the set of bars to the left are show 2018, 2019, 2020, 2021. And you can see how it's been growing over time. They then separated it into two areas. One is Europe, Middle East, and Africa, and the other is North America. And you can see that it's for the Europe, Middle East, and Africa, and this is primarily Europe, is 97% of these asset owners are planning to implement already are or are planning to implement ESG into their investment strategies. But you can also see a big jump with North America, and I think part of this is because of the COVID crisis, and I'll give you some evidence on that later. So what about individual investors? There's also been great interest in ESG by individual investors. And this chart, as Sam Hartzmark and Abby Sussman say, this is the paper in one picture. When Morningstar started sustainability rankings in March 2016, the flows that went into the high sustainability ranking funds really started shooting up, and the low sustainability ranking funds, the flows started going down. So there are a number of academic theories on why ESG could matter to firm values. And the idea is that firms with a higher ESG profile attract more or higher paying customers because they want to do business with a firm that cares more about the environment and social aspects. And they have there's evidence that they have increased productivity due to higher employee morale. The theories also say they attract shareholders who want to delegate their philanthropy to better inform corporate managers. They have managers who avoid myopic decisions. In other words, they avoid short-termism. The higher ESG profile as a result of agency problems. Managers want to optimize their own preferences, which would actually decrease value. And then one of the main ones is that that they can decrease firm risk. In terms of the motivations for ESG investing, if we look at the asset owners' views, what the FTSE Russell survey found was that 56% of the asset owners said it's about being a universal investor. In other words, a universal owner who has to worry about the externalities from other companies. And these were not mutually exclusive. 50% said it's about better portfolio returns. 46% said it reflects the preferences or concerns of their beneficiaries or stakeholders. And then a very small percentage, 9%, said they were willing to trade off financial returns for social or environmental impact. So for the most part, these asset owners believe that ESG is a positive investment strategy. We also found in a study I did with Parth Venkat and Chifei Zhu that it's the long-term investors who are the ESG investors. So when we looked at the average ESG score of portfolio holdings between all the way over to the left is the long horizon funds, and then it goes down to the short horizon funds. You can see that with both mutual funds or institutional investors that you find longer horizon funds tend to have the higher ESG scores for their portfolio holdings. The FTSE Russell also asks an asset owner's sustainability priorities, and again, this is divided up between regions, but overall, you can see that climate is a very high priority, as are social themes, governance, and lesser than is this idea of ethical, faith-based considerations. So a question then, is ESG adding value? Does ESG investing add value? And there's much evidence about this. And overall, while it's not unanimous, the body of evidence suggests a positive association between ESG or corporate social responsibility measures and accounting-based measures of performance. The market value studies are more mixed, but they also tend to find positive associations between ESG measures and firm valuation. Studies of market reactions to ESG news about a company find negative reactions to negative news, but mixed reactions to positive news. And studies of market reactions to announcements of issuance of green bonds generate positive market reactions. And so the idea behind this is that the companies can signal what they're doing in terms of the ESG, and that has been positively interpreted from the market. This classic study, which is a little old now, but I think it shows. This looks at SRI funds or ESG portfolios or corporate social responsibility measures, and they look at it in terms of using returns on firms, which is the leftmost bar. 56.7% of the studies find that there's a positive return. The portfolios, which are the gray bars, is a little more mixed in terms of whether there's a positive return. Some additional evidence that ESG considerations in the investment process adds value, but the more evidence weighs toward ESG adding value. And part of this difference, this mixed evidence, is due to the differences in definitions regarding an ESG product and how ESG integration operates in a portfolio. So more consensus exists on whether ESG considerations in the investment process help in mitigating risk. And that's what, I would like to talk about this ESG and lower risk. If you think about the types of ESG risk, and these are not mutually exclusive, you can think about it as systematic risk, reputation risk becomes very clear, litigation risk, supply chain risk, which is affecting us all now, corruption risk, climate risk, clearly. And so what I would like to do is just talk about just a few of these risks. So if we talk about systematic risk, there are practitioners that claim that ESG are risk factors, and they view ESG as a form of beta, of smart beta. So there are portfolios where they're using ESG for that. And the implications are from this that the risk factors are mispriced, and you can take advantage of this by constructing a portfolio with exposure to ESG. There's also theory about systematic risk being related to ESG. And the idea is that higher ESG companies have different systematic risk exposures, and the authors speculate either due to their resilience in periods of crisis or because they face a systematic ESG risk factor, in which case they command different risk premia and have different expected returns. And so the empirical evidence suggests that ESG is measured by MSCI ratings is negatively but weakly related to systematic risk. and that low ESG scores are positively and strongly related to financial risk. There's also studies of credit ratings, bond spreads, and ESG. And in general, these studies find that higher ESG results in better credit ratings and lower bond spreads. Corruption risk, which leads to reputational and financial risk. There is academic evidence that corruption can hamper firm growth. And in a McKinsey survey of CEOs, they identified corruption along with climate change as among the most critical ESG issues their companies must address to succeed in the future. So again, using ESG is one way of mitigating the corruption risk in a firm. There's also evidence on downside tail risk in ESG that having higher ESG can lower the downside risk. And in a study that I did with several co-authors, what we found was we looked at engagements by one large investor that had over 200 billion in assets under management, and the investor primarily uses a private and non-public route to engage portfolio firms. We examined 1,712 engagements across 573 targeted firms, and what we found was, while across all the engagements, there was no significant average reductions in downside risk. For those targets where the target management at a minimum acknowledged the existence of an ESG issue, then they significantly reduced downside risk. And we also found that engagement over environmental issues, primarily climate change, delivered the highest benefits in terms of the downside risk reduction. In talking about risk, I should point out that the World Economic Forum's top 5 risks in 2021 by likelihood, that 4 of these are environmental risks, and these are environmental risks that can affect firms. There have been predictions on the cost of climate risk that they're going to reach $1 trillion in terms of the biggest companies, and they're going to reach $31 trillion if emissions are not urgently reduced. So in a study that my co-authors Zach Sautner and Philip Kruger and I did, we found that institutional investors rated the importance of climate risk as being quite important, and that regulatory risk was, you can think of regulatory risk and technological risk. A lot of people lump these together as transition risk, but we found that those were relatively more important because they affect more companies than just the physical risk. And so one experiment a national experiment that my co-authors Lee Seltzer and Chief-A Zhu and I have done is to look at what the Paris Agreement did in terms of increasing regulatory climate risk. And I'm just going to show one picture from this study where we looked at the credit ratings on U.S. corporate bonds and how they changed for the companies that would be most exposed to this risk. So we looked at those in the high emission industries. We also did different definitions of looking at firms just by their emissions themselves, and we found very similar results. But as you can see from this, when we looked at we did this difference in difference test between firms in the high emission industries and those in other industries, and looked at the credit ratings around the Paris Agreement. And so the credit ratings were about the same across the firms. But then when after the Paris Agreement, the credit ratings for those in the high emissions industries dropped compared to firms in other industries. And we also found that this was largely driven by the bonds that were issued by firms that were in states in the United States that have higher regulatory requirements. So we do have evidence that it's the regulatory risk that was causing this change in credit ratings. One additional aspect of the political risk is, if you think about it, there's more risk now for firms because of ESG. The PRI has shown on this graph. It's the number of responsible investment-related policy instruments over time across the world's 50 largest economies. So the political risks, because of the increased regulation around ESG, ironically, has also gotten higher. And the PRI report also states that one notable exception to this growth is the U.S., the world's largest capital market. But with the change in administration since this report was written, I think that there's also obviously going to be increased regulation around ESG, because we're already seeing that with the Department of Labor and the Securities and Exchange Commission. Okay, ESG and COVID. I'm just going to go quickly through these results. These are, I want to show how investor perspectives in terms of ESG during the COVID period changed. So this is a picture from FTI Consulting survey of a large number of global institutional investors that had over $10 trillion in assets under management before and after the start of COVID. So the dark line was the August before, and this is how they thought, what extra percentage of corporate value would you attribute to a company if they had an extremely positive, in other words, a high ESG rating. And if you look at the August before COVID, you can see that it was going up. But if you look after COVID, in the February, it had really increased quite a bit. Also, there was a study that looked at the option adjusted spreads in basis points for banks that were either ESG leaders or ESG laggards during the first half of 2020. And you can see that the ESG leaders, which is the yellow line, had less spread than did the laggards. So it was affecting, again, people's perceptions of the risk of the banks during COVID. And then this study, they actually did a daily cross-sectional regression of stock returns from the start of the quarter with where COVID started in 2020, and they regressed it on a number of different variables. But the primary ones here are, they show if you had more cash to assets, your value was higher, going up. If you had more financial leverage, the value was going down, although then it got better. But notice that the ES rating, environmental and social ratings, actually just kept going over the period. So investors perceived that the companies that had higher environmental and social ratings were actually a safer, more resilient company to be in during the COVID pandemic. And then we also see similar, looking at China, you also see similar that the high ESG group of firms did better than the low ESG group of firms. There was also a study that used news coverage of corporate responses to the COVID crisis, and they found that there was where there was more positive sentiment, there was less negative returns during the COVID period. Then there was also a survey about credit risk and how that had to do with ESG. And one of the things is pre-COVID, environmental climate risk was very important. COVID really brought out the social risks that firms face. And as you can see with this, people felt that the COVID had more of an effect on the social part of the credit risk. Okay, so I want to spend a few minutes on the challenges with ESG. One of the fundamental problems is that many of the metrics on ESG are not clearly defined because the ESG ratings agencies develop different metrics. They give different scores to companies, and even clearly defined metrics on ESG are not well measured often because companies don't disclose enough data. So there's a survey of investment professionals on ESG information, and one of the questions that was asked in this survey is which of the following factors limits your firm's ability to use ESG information in your investment decisions. And 45% said lack of comparability across firms, 43% said lack of standards in reporting ESG information, and then there were other concerns that were expressed as well. And there a study that has looked at the different providers of ESG ratings and has argued that there's little clear measurement because of the differences. The average correlation was 54%, and they found that the differences arise due to the scope, measurement, and weighting. There's one, and so many people use this to argue that ESG is not a valid way to look at companies, that there's too much disagreement. But one thing that I think should be kept in mind, why should we expect high correlations? People keep comparing ESG ratings to credit ratings and saying, look, credit ratings, the three credit rating agencies, tend to have like over 90% correlations. But ESG ratings are not like credit ratings. In my opinion, the ESG ratings are people's different opinions on the environment, activities of a firm, the social activities of a firm, the governance activities of a firm, and the different providers measure these differently, as was pointed out in the paper by Berg, Coble, and Rigobon. There are differences because of scope, measurement, and weighting. So why would we expect these to be the same? I think of these almost as being more like the buy-side financial analyst recommendations than thinking of them as being like credit ratings. There are also measurement issues with climate risk. And I just want to talk about a few of these. But, if you think about climate risk, it is an environmental, social, and governance risk for investors. And we also need to understand better for the given investors how much of this is financial and how much of this is based on their taste and preferences. And it's become a first order topic for policymakers, partly because it's difficult to price and hedge, because it's systematic, we don't have enough disclosure, it's difficult to find a suitable hedging instrument. And even though climate risk is usually considered in light of its negative effects, it also can provide return opportunities, and we should think about it in that sense. I'm going to skip a little bit. So in a survey of large institutional investors worldwide, Emir Ilhan, Philip Kruger, Zach Sautner, and I found that we asked them how important they considered climate risk disclosure as compared to reporting on financial information. And what's striking to me is that 79% believe that climate risk disclosure is at least as important as financial disclosure. So there is demand from institutional investors worldwide to get this information. But when you think about what is the information we need, if we look at carbon emissions as a measure of climate, and they are the largest amount of the emissions, but which carbon emissions do we measure? Scope 1, Scope 2, Scope 3? Do we look at carbon intensity and normalize by sales, or do we consider, well, wait a minute, it doesn't matter how large you are, it matters how much emissions are you putting out? But in most countries, the companies do not have to report their Scope 1, Scope 2, or Scope 3 emissions. So there's a lot of information that we don't have. Some other issues about using carbon emissions to measure climate risk. How do we translate this into monetary values? What are the social welfare costs? Do we try to add those up, the cost of cleaning up? Do we try to consider the cost of reducing emissions, the opportunity cost of avoiding production, or the cost of using technology to reduce emissions? Do the measures truly capture a company's carbon emissions? Because companies can greenwash their carbon emissions disclosure, and there's insufficient data for scope 3, which in some ways can be the most impactful. And then why restrict emissions information to only carbon emissions? Shouldn't we understand all of the greenhouse gas emissions? Further, there's evidence that companies have incentives to, as I said, basically greenwash their emissions. There's evidence on U.S. firms that they change their production decisions. There's evidence that they shift production from highly regulated states to less regulated states. There's also evidence that firms are outsourcing their carbon emissions to overseas supply chain partners. And I just want to show you this picture in which the authors found that the dotted line is the total assets. The orange line is the scope 2 and scope 3 emissions. And then the blue line is the scope 1 emissions. So if they're outsourcing, their scope 1 emissions aren't going to be keeping up with their assets, but notice their scope 2 and their scope 3 emissions are doing that. And then there's also findings that ownership structure matters in terms of whether it's a private or a public firm, which is a concern with disclosing emissions. Beyond carbon emissions, there are other methods for measuring climate risk. There are linguistic measures. One of the very first was by a later speaker today, Rob Engel, along with his co-authors, where they look at this climate news index. There's also one where they look at discussions of climate change exposures in firms' earnings calls. There's a new one where the authors are looking at city financial statements, budgets, and bond prospectuses, and again doing textual analysis to try to pull out measures of climate risk. There's those that have used carbon beta. There are those that have used green factors, either on an ex ante or an ex post basis. There's those who have looked at carbon tail risk, and then there's lots of studies on the measures of sea level rise. So this is just showing the increasing questions regarding climate change risk during firms' earnings conference calls, and this was looking at more than 10,000 firms across 34 countries where they find this climate change exposure measure that they're using has been increasing quite a bit over time. Not surprisingly, there's been more interest, but it's a way of measuring for individual firms what analysts are concerned about in terms of climate risk. And they also use this just looking at the regulatory risk as well. So there is some hope that we're going to get more information about climate risk from firms, that we're going to get more disclosure, given the announcement last week about a new consolidated international sustainability standards board. And hopefully with this consolidation, there's going to be more transparency, there's going to be more coordination in terms of what we'll learn. So in conclusion, there's so much going on with ESG. I went so fast through this evidence, and particularly climate risk, and there's just so little time to talk about these.
Thank you very much, Laura, for this very insightful discussion. As you can imagine, we have received many questions from the audience, and let me lump together several questions that have to do with ESG performance and stock returns. Bob Jenkins from the CFA Institute is wondering about the statistical evidence that you have, whether the results are statistically significant, that ESG performance improves stock returns. And Michael Hain from City of Zurich Pension Fund is asking a more conceptual question. He's saying that the time horizon underlying empirical studies overlaps with a period of strong and increasing asset flows into ESG sectors and companies. Would you still expect any outperformance on a forward-looking basis once more investors have adopted an ESG strategy, and based on what rationale? Thank you.
Okay, so that is the hardest question there is, right? Is what's going to happen with ESG firms in the future? And if you look at some new evidence by Lubos Pastor, Rob Stambaugh, and Luke Taylor, they argue that in fact you're not going to see higher returns in the future because those returns have already occurred. And there is Roger Ibbotson also argues that if there's a popular investing style, it tends to get more returns as people move into that style. And so he has argued to me, well, ESG has just been a popular style, and that's why the returns have been higher. So I think part of it is trying to figure out how much of this is because of return opportunities, and I think it would be hard to expect a lot more return opportunities, versus how much of this is risk mitigation. And I think the risk mitigation, to me, is the stronger argument because you're less likely to have those downside risks.
Thank you very much. Mads Nielsen from ATP is asking the following. Given the large differences between E, S, and G, isn't it a problem to lump the three together when doing empirical analysis? What do you think?
Absolutely. Absolutely. I think for me, I think we do need to spend more time thinking about E, S, and G. It's been, and I've done this in my own work, it's convenient to put them together. And if you think of the issue that firms that are, what you would like to see is that firms that are better in E are also better in S and G, and perhaps they're not. I think the firms that are bad at one tend to be bad at the others. And so those that are in the lower part of the rankings are the ones that you could potentially lump them together. But I agree. We need to spend more time separating the E, S, and G.
Mm-hmm. Thank you. Manan Goleche from AQR is asking, how do you differ correlation versus causation between firms with better ESG profiles and better fundamentals?
I think that's very difficult. I think identification has become a word that I didn't hear a lot when I was early in the finance field, and now it's become much more important. So I think that's exactly right. Finding circumstances where we can show some causality rather than association is important.
Very nice. There is a question I have not heard before. So from Klaus Leonert from DXC Technology. Applying asset management and ESG to nation state as opposed to companies. Do you think that nation states need proper balance sheet instead of simple budget, which also includes common goods like our atmosphere as assets in order to enable a sustainable financial system? What do you think?
Yes, I do. I think you could do this. There's already ratings, ESG ratings of sovereign wealth bonds. And so in some sense, those ratings would be based on those economy and country factors.
Excellent, thank you. Milot Hassaj from Lampe Asset Management is asking, what is your opinion on greenwashing? How should the framework indicators look like for detecting potential greenwashing? What is the take of academic literature on this topic?
I think there has been research trying to detect greenwashing. There has been research that has, particularly, for example, with green bonds. I think, again, we need better disclosure and then it would be more difficult for companies to engage in greenwashing.
Thank you. So there's also a question about the multitude of rating agency you have touched on, and the low correlation among ESG scores provided by this rating agency. Do you endorse a specific rating agency? Would you like? Should we use an index of this rating agency? How do we think about it when they are so different?
So yeah, I would go back to the earlier point that was made about why are E, S, and G being lumped together, and I to me, and my understanding of what the investors that are using this information, they spend much more time on their reports and understanding the fundamentals of ESG than they spend on using these aggregated numbers, and so. Oh, and in answer to the first part of the question, no, I don't endorse any of these over the other. I think they're different. I think they look at different aspects, and there's a lot that can be learned from each of the different agencies, but particularly in their reports rather than in their ratings.
Thank you very much for your very insightful discussion and giving us all this academic evidence to reflect on. Thank you very much, Laura.